Have you ever thought about how amazing it would be to pay off your mortgage faster and save money on interest? Well, that's exactly what we're going to talk about today. In this video, we're covering when to refinance to shorten your loan term. By the end, you'll know if refinancing could be the right move to help you pay off your mortgage quicker and save thousands in the long run. Let's jump right in. First off, let's start with a simple question. What does refinancing even mean? Refinancing is when you replace your current mortgage with a new one. It's a bit like trading in your old car for a new one, but in this case, it's your mortgage. You might choose to refinance to get a better interest rate, lower your monthly payments, or in our case, shorten the time it takes to pay off your loan. So, why would someone want to shorten their loan term? Great question. The main reason is to pay off the mortgage faster. Instead of taking 30 years to pay off the loan, maybe you want to switch to a 15-year mortgage or even a 10-year one. The faster you pay off your loan, the less interest you'll end up paying. That means more of your money goes toward the principal, the amount you borrowed, instead of paying interest to the bank. But there's more. Imagine owning your home outright in half the time. That's a huge weight off your shoulders, and it opens up more financial freedom down the road. No more monthly mortgage payments means you can save more for retirement, invest, or just have more peace of mind. Now, let's get into the important part. When is the right time to refinance to shorten your loan term? The first thing to consider is interest rates. You'll want to refinance when interest rates are low. If you locked in a higher rate a few years ago, refinancing at a lower rate could mean big savings, even if you're switching to a shorter loan term. Lower rates will help keep your monthly payments from increasing too much. Next, ask yourself if your financial situation has improved. Are you earning more now than when you first got your mortgage? If so, refinancing might make sense. A shorter loan term means higher monthly payments because you're paying off the loan faster. If you can afford to pay a little more each month, this can be a smart move that will save you thousands of dollars in the long run. Another thing to keep in mind is how long you plan to stay in your home. If you're thinking about moving in the next few years, refinancing to a shorter loan term might not make sense. Refinancing typically comes with closing costs, like when you first bought your home. And you want to make sure you stay in your home long enough to make up for those costs with your savings. Refinancing to shorten your loan term comes with some great benefits. The biggest one is paying less interest. For example, with a 30-year mortgage, you could end up paying almost double the amount of your loan in interest over time. But with a shorter term, like 15 or 20 years, you'll pay much less in interest because the bank has fewer years to charge you for borrowing their money. Another benefit is that you'll build equity faster. Equity is how much of your home you actually own. And the quicker you pay off your loan, the more equity you build. This could be really helpful if you ever decide to sell your home or take out a home equity loan in the future. Of course, refinancing isn't right for everyone. The biggest downside is that monthly payments will likely go up. Since you're paying off the loan in a shorter amount of time, your payments will be higher. You'll need to make sure your budget can handle this change without putting too much strain on your finances. Another downside is the closing costs. Just like when you first got your mortgage, refinancing comes with fees like appraisal fees, origination fees, and more. These can add up to thousands of dollars. So you'll want to make sure the savings from refinancing outweigh the costs. Finally, if you're not planning to stay in your home for long, the time to recover the costs of refinancing might not make it worthwhile. You'll want to calculate your break-even point to see how long it will take to recover those closing costs through your monthly savings. So, how do you know if refinancing to shorten your loan term is right for you? It boils down to a few key questions. 1, are interest rates lower than when you first got your mortgage? 2, has your income increased enough to handle higher monthly payments? 3, are you planning to stay in your home for a long time? 4, can you afford the closing costs? If you answered yes to these questions, refinancing could be a great way to pay off your mortgage faster and save money on interest. Refinancing to shorten your loan term can be a powerful financial tool, but it's important to make sure it fits your budget and your long-term plans. If you're not sure whether refinancing is the right choice for you, we're here to help. For more information, or if you'd like to see if refinancing is right for you, be sure to connect with us. We'd be happy to help you explore your options and make the best decision for your financial future.